Hello, everybody. It is Wednesday, my favorite day. I am Stephanie, co-founder of Airdomo, and today I'm excited because we're discussing one of the most overlooked and misunderstood risks in international real estate. And it's money. It's my favorite thing. You know, my dog's name is Cash, right? So currency is what we're going to cover today, right? We're going to talk about when buyers purchase property abroad and they often focus on price, location, and potential returns, right? But what's rarely discussed is you may negotiate the price in one currency and earn income in another, right? And then watch the market move in a third. So this is a tricky conversation today, but that's why we're going to dive in and make you think differently than you've ever thought before. Hannah, where are you this week?
Yes, I'm here. I'm in Europe visiting my family, but I'm excited to be here and I'm excited for this topic because it's very, very important for all of our clients that are buying internationally. Sometimes we don't even think about this, right? But it really does create some layers of exposure that can significantly impact your real return, even if the property performs exactly as you expected it. So today we're going to break down how currency risk actually works, how it compounds over time, and how experienced buyers plan for it from the very beginning, right? So because currency doesn't really feel like a real cost in the beginning, it's kind of invisible. But over time, it can amplify gains and reduce returns, or it can completely change the outcome of a deal. So today we're going to talk about that. And let's start where the currently risk actually comes from. So where does it show up in a transaction?
Well, it's going to show up in three key stages, okay? First, in the entry, you're going to convert your home currency into the purchase currency, right? Second, it's your holding period. If the property generates rental income, it may be in a different currency than your base, right? So let's break that down real quick, just so people understand. Let's say you're purchasing the property in US dollars, but rental income is happening in pesos. Okay. So that's where it happens. And then the third is at your exit. So when you go to sell the property, you might be selling to someone who's coming out of France, right? So it depends on all of those parts. And so you might convert back, and that exchange rate may be very different than when you purchased it. So even if the property value increases locally, your real return is going to depend on the currency movements and what's happening there.
Exactly. So the property can actually perform perfectly just as you expected, and you still underperform because of the FX. So that makes sense. Let's talk about the three currency problem. You mentioned something that's interesting right there. There are sometimes three or more currencies involved. Can you explain that into more detail?
Yeah, and this is where it gets extremely complex, and I have to sit here and think about it myself a little bit. So let's say you earn in US dollars, but you bought in euros. The local market dynamics, they're influenced by GBP buyers. Now you have your base currency, your purchase currency, and the demand driving currency. Each of these can move independently. This creates a layered exposure that most buyers never model. And this is where AI can help you tremendously keep track of these things, because before we were building spreadsheets and looking at, okay, if the dollar's high over here and then it's low over here, and trying to keep track of how all of those layers are flowing. Now AI can actually help you do that. But Hannah, that's where it gets extremely confusing. But this is where the wealthy really pay attention. And it's almost like commodity trading, but they're doing it with money.
Yes, and real estate. So suddenly you're not just making a property decision, you're making a macroeconomic one, which can seem scary, but it's all really just planning. So let's talk about that currency impact return. How significant can this impact actually be?
It can be substantial. For example, a 10% currency movement can offset years of rental income, right? Or amplify appreciation significantly. So let's say a property appreciates 15% on the local level. but your home currency strengthens by 10%. Your real gain is closer to 5%. But on the flip side, if the currency moves in your favor, your return increases. So currency doesn't just affect risk, it affects the outcomes. Does that make sense?
Definitely makes sense. And I think most buyers don't realize that they're taking a currency position when they buy abroad. So that's definitely something to think about. And that's why we have you here, because I'm just not the type of person, for example, to think about these things. And I know when I buy real estate, I look at where the vineyard is, where the beach is. And that's why I would need a partner like you. And that's why our clients come to you, because you understand this and you know how to plan this out, which is amazing. So let's talk about that. How do sophisticated buyers think about the FX?
Well, here's the thing, they don't ignore it, okay? But they also don't try to predict it perfectly. We can never predict exactly what's going to be happening, okay? But we focus on the alignment. We ask, am I buying in a strong or weakening currency, right? Does my income match the property currency? Am I comfortable holding exposure to this currency long term, right? In some cases, they intentionally diversify, just like we do in stocks, just like we do in buying in different places. We may hold assets across USD markets, so US dollar markets, or Europe markets, emerging market currencies. There are a lot of markets outside the United States that actually trade in US dollars, okay? And so you'll see that as you start shopping for real estate. And that is exactly why they do, to make the currency line up, because that's where their buyers are coming from. But currency becomes part of your portfolio strategy, not an afterthought. So you've got to think about, I know we've got a long list of what we have to think about, right? We can't buy emotionally. We have to answer all of these questions ahead of time, but we also have to think about currency as well too, especially if it's in a turbulent market or economy.
And instead of eliminating the currency risk, sophisticated buyers actually manage and distribute it, which is where the winning strategy is. So let's talk about natural hedging. Is there a way buyers can reduce the currency risk without complex financial tools?
Yeah, and that's what natural hedging actually is. So, for example, if you earn in US dollars, buying in US dollar based markets reduces mismatch. It keeps it simple and it keeps it easy. I know that when I go to purchase in a market that's selling in US dollars, I know that the income typically is coming in US dollars. I don't have to worry about the differences in currencies and so forth, okay? But if rental income, if it's all in your same currency as your purchase, that stabilizes your returns. If you plan to spend time in that country, currency risk becomes less relevant. But in other words, aligning usage, incomes, and ownership reduces exposure. If you line up, if you're purchasing in US dollars, but the income is in a completely different currency, like pesos, for example, that's when things really change. Even when we are representing property that are in the peso, things fluctuate in a massive way on a daily or on an hourly basis as that currency changes.
And that's a very practical way to think about it, aligning your life with the investment, actually. So, understood. When currency risk can actually be an advantage, those scenarios exist as well. Can currency ever work in the buyer's favor?
Absolutely. Many buyers enter markets when their home currency is super strong. So that gives them more purchasing power, right? It becomes that buyer's market, more purchasing power. They can get more for their money, lower effective entry costs, more for their money. Then, if the currency normalizes or weakens later, they benefit on the exit. So this is especially common with United States buyers in emerging markets. We in the United States have what's called the seller's market or the buyer's market. And that always is based on demand, right? And how many listings versus how many buyers are out there. European buyers in certain regions as well. GBP buyers in specific cycles. But again, this should be a bonus. It's not the only reason to invest. You don't sit there and wait for these things to do the roller coaster effect and then decide, to make that purchase.
Yes, because currency can enhance a good deal, but it shouldn't really justify a bad one.
That's right.
Exactly. So let's talk about what our audience really likes to hear about, and that's common mistakes. So what are the common mistakes buyers make around currency?
Well, the biggest ones are ignoring the FX entirely, assuming stability where there isn't any, right? I mean, you can't just assume everything's going to be stable, not factoring currency into return calculations. That's a big one. We have to always think about that, especially if your currency is not lining up, right? Not factoring or overexposing themselves to one currency. Okay, so maybe if you're in a portfolio, you want to diversify across different currencies so that if one is turbulent, the other ones are stable. And then making short-term decisions in long-term assets. And perhaps most importantly, not asking the questions early enough. We say this on every single webinar, which is why we do this, which is why we founded Airdomo, is because people simply don't ask questions. They seem to put in the offer or put in the deposit, and then they start to ask these types of questions, and then it's an afterthought. And that's the wrong time to have an afterthought, people. We need to be having these ahead of time.
Yeah, because by the time you ask, you're already locked into the exposure, and then it's a big mess to fix.
Yeah.
Stephanie, what this really shows is that currency is not just a technical detail, it's a core part of the decision. So for everyone watching, if you are considering buying property internationally, and understanding that currency exposure up front can make a significant difference in your long-term results. So on airdomo.com, you can explore the opportunities across multiple countries and multiple currencies, which is a great way to start thinking about how your portfolio could be diverse globally. And if you'd like support, you could definitely book a call with us, where we'll help the buyers think through not just the property, but the full strategy behind it, including the currency exposure. I want to thank everyone for joining us today, and we'll see you next Wednesday.
Thanks, everyone.
Bye.